The Philippines is eyeing export restrictions on nickel ore, hoping to replicate Indonesia's success at moving down the battery value stream. Indonesia implemented a policy to ban exports of nickel ore in 2020, with the aim of promoting downstream industries, particularly in the production of nickel pig iron and stainless steel. The policy was successful in increasing domestic processing of nickel and boosting its nickel exports from $3 billion to $30 billion in 2 years. Inspired by Indonesia's success, Philippines Trade Secretary Alfredo Pascual said the agency is weighing whether to impose an export tax on raw nickel exports or ban or shipments completely. Both Southeast Asian countries are rich in nickel laterite ore, which is refined into nickel for batteries and stainless steel. The Philippines accounted for 10% of global mine nickel output in 2022, second only to top producer Indonesia, which produced 48.8%, according to the U.S. Geological Survey. The Philippines has 55 metallic mines and 7 mineral processing plants, including 2 for nickel operated by Nickel Asia Corp., which is partly owned by Japan's Sumitomo Metal Mining Company. Loizaga said her target is to add 3 more mineral processing facilities during her term. Manila's goal with the export restrictions is to produce more refined nickel products and ultimately support the development of refining and manufacturing of battery components, and even rechargeable batteries, Pascual said. Duplicating Indonesia's success will not be easy. So far, the Philippines has been less attractive to downstream companies than Indonesia, analysts said. The Philippines has stricter environmental requirements, smaller nickel reserves, and less metals and mining infrastructure than Indonesia, according to Gao Yuan, a nickel analyst at Shanghai Metals Market. Still, the Philippines could become a secondary destination for companies seeking to mitigate regulatory risks around the Indonesian government's ever-changing commodity export policies. Indonesia lifted a 2014 export ban on unprocessed nickel ore in 2017, then reimposed the ban in 2020. It could be a good alternative to have a smaller operation in the Philippines just for contingency because Indonesia has resorted to very drastic policy changes, ING's Mappa said. Philippines officials have seen growing interest in foreign investment. Chinese investors pledged to invest $7.32 billion in the electric vehicle and mineral processing sectors in the Philippines during President Ferdinand Marcos Jr.'s first state visit to China on January 5. Loizaga said the government is in talks with some large-scale miners from Canada and Australia to invest in the country. At home, it is also pushing for mining projects stalled for years by changes in mining policy, including the Tampican mine in southern Mindanao Island. The mine, one of the largest untapped mineral resource in Southeast Asia and estimated to yield 375,000 tons of copper and 360,000 ounces a year of gold in concentrate over a 17-year period, had been halted by the open-pit mining ban, prompting Glencore plc to quit the project in 2015. In addition to the above subjective problems in the Philippines itself, after the mining ban in Indonesia, the main source of Chinese nickel imports is the Philippines, which is in short supply. According to the current 1.5% Philippine ore price, 1.8% Philippine nickel ore can be sold for nearly $100 per wet ton in China, while Indonesia's 1.8% grade ore is less than $40. After deducting transportation costs and mining costs, the intermediate profit can reach more than $70 per wet ton, which is a high profit available quickly. Compared with this, it takes much longer to attract foreign investment to export high value-added products after the mining ban. Taken together, although the market rumors propose that the Philippines ban nickel ore exports, SMM believes that the Philippines is less likely to follow Indonesia's ban on nickel ore exports.